You're listening to Money Never Sleeps Radio. In your face.
What we got here is a failure to communicate.
Oh, have I got your attention now?
Greed, for lack of a better word, is good.
You know what I mean?
Money to be made in a place like this.
Money never sleeps, pal.
You're crazy. Don't run when you lose. Don't whine when it hurts.
You know what it takes to sell real estate?
It takes brass.
I've fallen, and I can't get up.
All right, welcome to Money Never Sleeps. This is a show where we talk about anything and everything that impacts the flow of money from around the corner to around the world. And today I want to put a focus on tokenization, because what we're going to see is a lot of tokenization transpiring across traditional markets, from the New York Stock Exchange to the Nasdaq to other international exchanges. Even with the CME tokenizing commodity futures, this is a big transition. This is taking traditional rails and building infrastructure on top of it. That infrastructure that's being built on top of these rails that are providing the onboarding of the digital evolution of sorts. This is blockchain evolution. Let me correct, blockchain evolution. This is going to allow for the progression of what will be the most transparent markets that we're ever going to have. It's going to provide us with a scenario where you're going to have seamless interconnectivity from the exchanges to the brokerage firms to the transfer agents to the custodians to the compliance and across the board to the regulators. I mean, this is going to be unprecedented, and this is going to allow for a more robust market, faster market, potentially 24-hour, 7-day-a-week markets. We will see what's going to come there. But what I want to do, I want you guys to listen to this overview in regards to the tokenization and the move from theory to infrastructure as the major exchanges are preparing for the next market evolution, which is in front of us right now. So take a listen, and I'm sure you're going to find it extremely informative. And just hang on and just take a listen to it.
A quiet but profound shift is taking place across the architecture of global financial markets. Major exchange operators, including the Nasdaq, the New York Stock Exchange, and the CME Group, are actively exploring and developing frameworks for the tokenization of securities and commodity derivatives, a move that could fundamentally reshape how assets are issued, transferred, cleared, and traded. While tokenization has often been misunderstood as merely placing a digital wrapper around existing assets, the implications of full-scale exchange adoption suggest something far more structural, a modernization of the underlying infrastructure that governs how securities and futures contracts function. In essence, tokenization may represent the most significant transformation in market plumbing since the transition to electronic trading. For decades, securities have technically been digital, where ownership records are maintained electronically through a complex web of intermediaries that includes custodians, clearinghouses, broker-dealers, transfer agents, and settlement systems. However, those records are fragmented across multiple databases. Tokenization introduces a different paradigm, a shared, cryptographically secured ledger where ownership, settlement, and compliance logic can exist within programmable smart contracts. For exchanges such as the Nasdaq and the New York Stock Exchange, this means that securities could eventually be issued directly onto blockchain-based infrastructures, where the asset itself carries embedded operational logic. That logic can automate settlement processes, ownership verification, compliance restrictions, dividend distributions, corporate actions, but instead of relying on multiple intermediaries to process these functions. If major exchanges begin listing tokenized securities, the implications extend far beyond the trading venues themselves. Every intermediary that participates in the securities lifecycle would need to adapt. Transfer agents, custodians, clearing firms, broker-dealers, and compliance providers would have to integrate blockchain-based systems to continue servicing those securities. Transfer agents in particular, responsible for maintaining shareholder records and processing stock transfers, would face a structural shift. In a tokenized environment, share ownership can be verified directly on-chain, meaning record-keeping systems would need to interact with distributed ledgers rather than internal databases. Similarly, broker-dealers and trading firms would need systems capable of handling tokenized securities, including custody infrastructure and blockchain-based settlement. Market makers, critical liquidity providers across all exchanges, would also have to integrate blockchain settlement systems into their trading architecture. This transformation would not stop with the major exchanges. The OTC Markets Group, which hosts thousands of small and emerging public companies, could eventually face pressure to adopt similar infrastructure if tokenization becomes the standard for companies seeking to uplist to larger exchanges. In other words, once the top tiers of the market modernize, the rest of the ecosystem may have little choice but to follow. One of the most significant implications of tokenized securities is transparency. Blockchain-based systems can provide real-time visibility into share ownership and transaction history, dramatically improving the ability to detect irregularities in trading activity. Practices such as naked short selling, where shares are sold without being borrowed or located, could be significantly reduced or even blocked automatically through smart contract enforcement. Settlement could also accelerate. Today, most U.S. equity trades settle on a T+1 basis, meaning transactions are finalized one business day after execution. Think about this, that tokenized settlement systems could allow near-instant settlement, reducing counterparty risk and freeing up capital that is currently locked during the clearing process. For investors, the benefits include faster asset transfers between brokerage platforms and greater transparency around the actual supply of tradable shares. The implications extend beyond equities. The CME Group, which operates some of the world's largest derivatives exchanges, has already shown interest in blockchain-based settlement infrastructure for financial instruments. Tokenization could eventually transform the structure of commodity futures contracts. Currently, global commodity markets operate on fixed trading schedules, with most futures exchanges closing over weekends. But blockchain-based markets operate continuously. If futures contracts were issued and settled on tokenized infrastructure, the possibility of 24-hour trading, including weekends, could emerge. Digital commodities such as Bitcoin already trade continuously across global markets, offering a glimpse into what round-the-clock commodity markets could look like. While extending that model to traditional commodities such as oil, gold, or agricultural products would require regulatory and operational adjustments, the technological barrier is rapidly shrinking. Perhaps the most immediate beneficiaries of this shift may be the trading platforms already comfortable operating at the intersection of finance and digital assets. Brokerage and crypto trading platforms such as Robinhood and Coinbase have built infrastructure capable of supporting both traditional securities and digital assets. As tokenized securities begin to emerge, these hybrid platforms may be well positioned to serve investors seeking seamless access to both markets. At the same time, centralized and decentralized digital asset exchanges could increasingly play a role in facilitating liquidity for tokenized financial instruments. The result could be a market structure where traditional finance and blockchain-based trading venues operate far more closely than they do today. The tokenization of securities and derivatives is often framed as an experimental concept, but the involvement of major exchange operators suggests something more consequential: the modernization of global financial market infrastructure. If exchanges such as the Nasdaq, the New York Stock Exchange, and the CME Group move forward with large-scale tokenization initiatives, the ripple effects could reshape the roles of intermediaries across the financial system. From transfer agents and market makers to broker-dealers and clearing firms, the shift would require new technological capabilities and operational models. But it could also bring unprecedented transparency, faster settlement, and stronger safeguards against market manipulation. For investors and market participants alike, the message is becoming increasingly clear. The infrastructure of finance is evolving, and those prepared to operate within that new architecture may find themselves at the center of the next era of global markets. The question now is no longer whether tokenization will arrive. It's whether the market is ready when it does.
As I said, very informative, and it's stuff to think about, because this isn't just, talk. This is something that's actually in the process of happening, and it will happen. And bear in mind, those companies that are creating the infrastructure, those are the ones that are going to be benefiting on a nubile level from what's going to happen. And it's like the pick and shovels, right? When the gold rush transpired, you had miners going there. They were going and trying to mine, but it wasn't those guys that really made the killing. You may have had a few people that did very well, but it was the ones that were selling the jeans, the wood to frame out the mines, the pans, the picks, the shovels, everything, the hats, everything in that realm. Those are the ones. They provided the infrastructure in order for it to happen. They didn't create the mine. They didn't create the gold. They provided the infrastructure. And that's what you're going to see here, people. That's what you're going to see here. So that infrastructure is highly important. Anyway, I want to thank you guys for tuning in. We did something a little different today for that reason, to provide as much information as we can to the general public and to our listeners. All right, so thank you. You guys have a great weekend, and we'll be back with you with another episode of Money Never Sleeps next week. Take care.
Initiating shutdown sequence.
You're listening to UCW Radio. In your face.
What is your major malfunction?
So let it be written. So let it be done.
Ladies and gentlemen, my mother thanks you, my father thanks you, my sister thanks you, and I thank you.
The views and opinions expressed on Money Never Sleeps Radio are for informational purposes only and should not be construed as financial advice. The host Louis Velazquez and guests of Money Never Sleeps Radio are not licensed financial advisors, and any investment decisions made based on information presented in this podcast are at the listener's own risk. Listeners are encouraged to consult with a qualified financial advisor or investment professional before making any investment decisions. The podcast hosts and guests do not endorse or recommend any specific investment strategies or products. All investments involve risk, and past performance is not indicative of future results.